Hello, everyone. I'm going to start by saying it's an interesting forum. Obviously, the past couple years, our presentations have taken on this shape. I personally preferred in-person presentations. I like to gauge the audience. I like to see faces to see whether or not my ideas and my discussion is going over well, whether or not I have to be more detailed. But I've learned to enjoy this as well. The presentation today, it's interesting. I took two concepts and I joined them into one. And this is actually a true live case, successfully closed case that myself and an advisor worked on. It's looking at corporate estate planning and looking at the IFA. Now, we could do an hour or 2 hour long presentation on either of these topics. And I'm sure that you've seen individual presentations on corporate estate planning, individual presentations on the IFA. What I'm meant to do today is talk to you about both of these issues or these concepts, but more importantly, show you how they came together very nicely in the case. And I start with a little bit of technical. You'll see in a few seconds. I'm going to do a few technical slides on the IFA just to get you reconnected with some of the technical issues. But then immediately after I talk about the IFA and show you some slides on that, I'm going to show you the exact presentation that I showed the client. So on every case that I work on with an advisor, I do a deliverable, and you'll see the exact deliverable that I delivered on this case that got us all the way from client meeting to accountant meeting to settled policy. So this slide, I just threw this slide in to start out and give me a bit of a starting point, a baseline. I think that the slide speaks for itself. We all know, and business owners have a good understanding that when they die, there's going to be a huge liability to the family, and that liability to the family will be taxed. And it's not necessarily that that the tax liability is something that they can't plan for. It's just sometimes they don't necessarily want to plan for it. They don't want to put the cash into an insurance premium that is going to pay the bill at death. So, in the middle of the slide there, I talk about, think about that operating business whose value is $10 million. And at the time of transition to the next generation, it's $10 million. Well, if I think about the capital gains tax at death on that operating business, who has $2.7 million? That's the capital gains tax rate in Ontario. Who has $2.7 million of cash to write the check to the CRA? So this is all very simple stuff. You need life insurance, right? In big, bold letters, life insurance is the simple solution. Well, if the simple solution was that we just go around selling life insurance for capital gains tax on death, then advisors wouldn't need help from Frank. We'd just go out and find clients that had capital gains tax issues. Why do we have to put ourselves out there? Why do we have to sell the case? Well, because the premiums on a $2.7 million policy are not very low. They're going to require a lot of cash. And you got business owners that say, why the heck would I spend X amount of dollars per year on an insurance policy to provide cash 20 years from now, 30 years from now? I could take that same money and grow my business. Okay, great. So we know what the problem is. We have a liability of $2.7 million at death. We know what the solution is, life insurance. Where's the bridge? How do we bridge that gap? How do we take care of those premiums when we know that cash flow is so important to the business? Or it might be a business owner that it's not important to the business, but they just want to use it on investments that they think will reap better benefits than a life insurance policy. Immediate finance arrangement might be the solution. So quickly, I'm going to go through these slides rather quickly because I think most of us in this industry have seen this type of presentation before, and I think we all know inherently what an IFA stands for or how it works. Number one, very simple, buy a high cash value permanent insurance product. Most carriers out there, if not all, carry some sort of a high cash value product that would allow for an IFA. Number two, assign policy to lender immediately. And it's interesting that we say, number one, we buy that policy, and number two, we assign the policy. And I say that that's interesting because when you come down to the process, you're not borrowing money to put into the policy. You're putting the policy in force with your own money, and then a few weeks after, once the assignment on the policy has taken place, the lender will give you that money back in the form of a loan. And that's very important because a lot of times people think, well, I'm going to borrow and that borrowed money goes right into the policy. Absolutely not. You have to place the policy, step one, with your own money, and then of course, borrow back after it's been put in place. How much do we borrow back? Old presentations of mine had 90% of the cash value, but I realized more and more lenders are looking at 100% of the cash value. They're looking at 100% typically of current -1. They feel very safe at a current -1 illustration to give you 100% cash value. And of course, my second bullet there, additional collateral is going to be needed when we're short. So if I put 100,000 in year one, I know that most products won't have 100,000 of cash surrender value in year one. They might have 70. Well, that gap of 30,000, you're going to have to post alternate credit, maybe a letter of credit from the bank. Some sort of acceptable collateral has to be posted to get us up to that full 100,000. Step 4, very, very important. Step 4 is that you do something with the borrowed money, right? So why are we going to do an IFA if we don't have anything to do with the money? Don't do an IFA. Take the money, put it into your operating business, buy real estate, do something of an income earning reason. Step 5, death benefit repays the loan and remaining proceeds go to the corporation. This is exactly why we do an IFA, because we know in the industry that the loan amount is equal to cash surrender value and the death benefit will always be a number over and above. So we're buying insurance for the amount over and above the loan, which is attached to the cash surrender value. And of course, as an accountant, what I love is the tax-free capital dividend to the estate when we do this in a corporate setting. Why do people leverage? Well, nowadays, a lot of people are leveraging. One thing I didn't talk about was interest rates here. And interest rates, sorry for going back and forth, this is the best time to do an IFA. Typically, lenders are doing IFAs. They're lending out money at prime at the minimum, and I'm seeing all the way up to prime +1. But even at prime +1, you're getting your money back at a rate of 3.5%. So most of the clients that I'm working with, they say, absolutely, let's leverage it back. If we pay 2.5 to 3.5%, that's fine. We need the insurance, we need to preserve the cash, and we know that there's going to be tax benefits. So right off the bat, if I know that I'm paying interest at prime, call it 2.5, 3%, let's say. I pay 3% interest. If I get a deduction at a passive income tax rate in the corporation, I save 50% tax because the interest is deductible. So now my net cost of interest is only 1.5%. And by the way, there's something called the collateral loan deduction that says a portion of our premiums, or NCPI, will be deductible as well. Tax rules, so the interest deductibility, for it to be deductible, the interest has to be paid or payable. There has to be a legal obligation to pay the premium. And the purpose test and linking test, we have to just make sure that the borrowed money is used for an income to purchase an income earning asset or to put back into our business. Basically, it's laid out to earn income. And with respect to the insurance premium deductibility, that's what we call the Section 21E.2 collateral loan deduction. Here's the rules that we have to satisfy for deductibility. Assignment of the policy has to be required by the lender. The lender is a restricted financial institution. Fine, all of our IFA lenders are. Interest on the loan is deductible. Absolutely, we'll make sure that we're borrowing for income earning purposes. The amount that's deductible is the lesser of premiums payable and net cost of pure insurance. And the amount has to be the amount that's related to the amount owing. And what all that means is if we had $100,000 of loan outstanding, but our death benefit was $1 million, then we have to prorate the amount of the deduction. So what are some of the things that we have to consider as variables? Because of course, it's not one and done. We have to consider that we're doing two separate transactions. And this is very important. I'm always educating clients to say, you're buying two things here. You're buying an insurance policy, and then there's a separate transaction to get a loan. It's not as if we're doing all of the borrowing all at once, or I'm sorry, the full transaction all at once. I'm sorry, sometimes when I lose my train of thought, it's because my eyes go to the chat. Fantastic that you're giving me questions. I'm not going to answer questions until the end if I have time. Most likely I won't have time. If that's the case, then I will address them after the fact. So we have to look at loan terms. We have to consider loan repayment. As far as I understand, most of the times these loans are open for repayment. I get a lot of clients that say, hey, Frank, if I buy an asset like a real estate property and I later sell that real estate property and I have proceeds, can I repay the IFA loan? And the answer is absolutely. You repay the IFA loan and then you have more death benefit going to the family. Deductions. So this is very important because the IFA assumes that you're deducting that interest all the way through until mortality and that NCPI or premium amount. Now let's make sure that we have income to write the deductions off against. Okay, so that's important. Make sure that we have income in the later years. It would be foolish of us to say someone that stops earning income or a business that is wound down will be able to use these deductions. So it's important that we consider that. Tax rates. Does the individual have passive income in their business where the interest deduction is coming off at 50%? Or are we only looking at active business income where in Ontario the rate is only 12%? Then the deduction is not as lucrative. Policy performance. You know, we're running these policies at current -1 for purposes of an IFA, but of course, how will the policy perform? In a PAR, there's guaranteed components, but of course, we're lending against the non-guaranteed current -1. And the last point, investment and business performance. All of us in this industry, we don't have any control over where they put their funds. But of course, we want to make sure that they're putting their funds, or you want to ensure that they're doing something smart with their money. Not always the case, but of course you're borrowing so that you could enhance your position by buying an income producing asset, not a losing asset. I'm going to find this a good time to take a little break. Wow, I raced through that, and I apologize to anybody that is not familiar with the IFA, but I needed to do that quickly so that we can get to the interesting stuff. So what you see now, I'm going to repeat this. What you see now is exactly what I presented to John and Sarah. That's not their actual names. They're different clients, but this is the exact deliverable that I give to a client. Now, I'm going to warn everybody. I don't go into this much detail for all the clients that I transact with. I usually do a deliverable, and maybe about 75 to 80% of what I go through here would be with any other client. But this client was extremely technical, and he says, Frank, if you can go down to the nth degree, treat me as if I'm a CA. He says, I'm a quick learner. So I said, fantastic. I will go to the nth degree in terms of the technical aspect of this. And it's good because I thought this is the perfect presentation to show a group of advisors. But just keep in mind, I'm going to tailor my presentation to whomever the user is. And in this case, the user was extremely technical, and I tailored it for him. I just don't want people to think, I don't want Frank in front of my client because he gets too caught up in the weeds. This client wanted it caught up in the weeds. Okay, so let's talk about the facts. We have John and Sarah, husband and wife, married with 2 adult daughters. So their 2 daughters are aged 25 and 24. John's 55 years old and Sarah's 57 years old. John and Sarah have built a substantial real estate portfolio. They have 8 rental properties. And when I say 8 rental properties, many of these are multi-level properties, multi-unit properties. So he's got roughly about 30 to 40 rentals or tenants, so to speak. So it's a sizable business that he's built up. And a majority of it is within a corporate structure. Only a couple of them are outside of the corporation. The shares of the corporate group are owned 50% each by John and Sarah through their holdco. So I look at the structure, and we have John and Sarah off to the left. Don, just give me a quick yes or no whether or not you can see when I have my cursor there. I don't want to waste my time with my cursor if no one can see that.
Run your cursor across, Frank.
Yeah, I'm doing that now. No, can't see it?
Can't see it. No.
Okay. So over to the left, I have John and Sarah. You can see that they own 100% of Holdco, and the ACB, the adjusted cost base of those shares, is 0. So I'm quickly going to give everyone an education as to why adjusted cost base of shares is usually 0. I call it 0. It's usually $100. How the heck could anybody amass a business with a cost base of 0 or $100? How the heck do we capitalize? That's my favorite words. Advisors that work with me, they'll see in my discovery meeting, I always ask, how did you capitalize the business? Well, we capitalize the business usually via a shareholder loan. So if I were to look at the financial statements for Holdco, the financial statements for Holdco may have an outstanding amount to John and Sarah, shareholder loan, that they injected of their personal money. And that's absolutely how he started his whole empire of real estate. He took a leverage or a loan against his principal residence, invested it into Holdco via a shareholder loan. He lent it in, and Holdco then started to buy their real estate. So when I look at Holdco right now in the portfolio value of the real estate, he's got fair market value of $14,600,000 minus debt of about $4.6 million, and we have a net fair market value of $10 million. That's the value of Holdco right now. On the right-hand side, I'm not going to get too involved in that. I've got enough to talk about in this, and to be honest, we didn't focus on it in the client presentation either. I just listed it because it was the asset that we talked about, but we just focused on the left-hand side. This, very verbose, all it says is we have to watch out at death. Like my opening slide, it says when both John and Sarah die, there's going to be capital gains tax on that second to die. Okay, well, we have a problem because on the second to die, we have assets, but we don't have cash. So on the second to die of John and Sarah, when these shares go to the estate, when the shares of Holdco go to the estate, we've given them a fantastic thing. We've given them a company worth $10 million, but we've also given them a cash liability of $2.7 million. I'm strictly doing capital gains tax at death, $2.7 million. We have a cash liability owing on our assets. So how the heck do we create liquidity? Well, thank God for our industry, because that's what we do. We're the masters of creating liquidity at death to solve problems. I don't sell life insurance. Not that there's anything wrong with selling life insurance. I sell insurance solutions to big problems that people have. That's what we all do at the end of the day. And this is basically just a summary. I just showed him how we have to address the $2.7 million. Plus, we also have to think about the rental 1 and rental 2. But again, our focus going forward, we just focused on those Holdco shares. No word of a lie. It's not as if we focused on rental 1 and 2. He just wanted to focus on Holdco shares and that $2.7 million capital gains tax at death. I apologize. I need to move my box. There we go. Okay, so let's reconcile where we're at. We have $3.3 million of tax total at death today, by the way. That's today. $2.7 million is the amount that I'm hired to, not hired, they don't hire us, but I'm engaged with solving for. I know John and Sarah are astute, and I know that they've bought real estate in some good areas, and I know that that value is not going to be $10 million when they die. It's going to be probably closer to $20 or $30 million when both of them die, assuming second death at year 30. So I'm sure that most people have heard of the estate freeze. What do we want to do? We want to freeze John and Sarah's value. Basically, what you're doing with a freeze is you're saying, hey, time out. I never want my taxation to grow over and above where we're at now. I'm going to freeze my value and I'm going to do that by taking back preferred shares, and the new common shares, because we have to have common shares, those are going to go to a family trust. So here's how we look, organizational structure post-estate freeze. So please look at the left-hand side. The left-hand side shows that when John and Sarah implement this freeze, they're taking back preferred shares worth $10 million, but the adjusted cost base is still going to be 0, right? We're just saying we're locking in our value. We don't want any more growth to accrue to John and Sarah. Who gets the new common shares? Well, the new common shares will put them to a trust. You can see that I've issued 100% of the common shares to a trust. How much does it cost for the trust to buy these common shares right now? Costs them nothing, because all of the value is in the preferred shares. Fantastic strategy. Now we have new growth going to the trust. So if I look at year 30, what's happened to all of the growth? And now I'm assuming that John and Sarah die at year 30. Okay, this puts them in their mid-80s. What happens at their second death? First thing up at the top, John and Sarah have a capital gain at death related to the preferred shares of $10 million. Tax, I'm taking roughly half of 53%. That's the Ontario top marginal tax bracket. So half of that is roughly 27%. 27% of 10 million gives me a tax bill of $2.7 million. The preferred shares are now owned by the estate, and they have a fair market value and adjusted cost base of $10 million. We bumped up the ACB because we paid tax on those shares. Fantastic. Net fair market value of Holdco. Well, 30 years from now, I'm saying maybe Holdco was worth 20 million. Good. Make it worth 100 million. It doesn't matter. John and Sarah's tax does not change because they did a freeze. So who's got the value of the $20 million now, or the extra 10 million? The extra 10 million are inherent in the shares that daughters own. And why do I have trust not owning any shares? There's something called the 21-year rule. At year 21, I roll the shares out to the daughters at adjusted cost base. Fantastic. Everything is fine and dandy. I wish we were in a live room right now so I could see your faces as to whether or not you understand this. I'm going to keep pressing through this. Maybe I'll just summarize this by saying what you should take out of this slide is that because of an estate freeze, regardless of what the value is at death, regardless of net fair market value of Holdco, John and Sarah's tax liability will never be higher than a capital gain at the freeze value of $10 million. Great. So that $2.7 million life insurance need, we know that that's that, and we can address it. This actually just talks about everything that I just showed in writing. The one thing that I'm going to look at right now is number 4. So number 4 says, okay, we've done everything. Now we need $2.7 million of cash to pay the tax. And the $2.7 million of cash if mysteriously it wasn't Holdco. So let's assume that John and Sarah said, Frank, you know what? We're going to put money aside in a piggy bank in Holdco. We're going to self-insure. We're going to create a sinking fund. Well, fantastic. John and Sarah, now that you have $2.7 million, how do we get it out to the girls? How do we get it out to the estate? Well, we'd have to pay a dividend to the estate. And they're going to scratch their head and they're going to say, oh my God, isn't that double tax? If we paid a dividend out to the estate, we'd pay personal dividend tax. I'm doing good pace. I'm surprised. I'm going to have to slow down a bit. So here's what most good tax accountants, if they're not good tax accountants, they should realize that when a death happens to their clients that are owning private corporation shares, if they don't know this slide, then they're in trouble. They should refer their work out to an accountant that understands this slide. And what this slide says is that when we have a corporation or an owner of corporate shares at death, we have to do something. We have to do what we call some form of post-mortem planning in order to avoid double tax. On the left-hand side, we have something called a share redemption by the estate. The right-hand side is what we call a pipeline. I think you've all heard that in the industry. I'm going to read through these bullets just because it's very paramount to the next few slides. So let's look at a share redemption by the estate. First thing that happens is the estate receives those preferred freeze shares and they redeem some of the shares or all of the shares. I go back and I show you these preferred shares that the estate received with a fair market value and an adjusted cost base of $10 million. I'm suggesting that post-mortem planning is going to require us to redeem some of those shares. Redemption, when we do this thing called a redemption, we're going to create what we call a deemed dividend and a capital loss. I'm actually going to go through this very technical process in a slide or two, of showing you how we create a deemed dividend and a capital loss. Fantastic. Third bullet. Capital loss is used to offset a capital gain on terminal return. Let me go back up to my picture. If I have a capital loss, I could go towards the left-hand side and reduce that capital gain of $10 million and reduce that tax bill. But what's going to happen? If I create a capital loss and I create a redemption, I've just created a dividend. So net result at death is tax on a deemed dividend instead of a capital gain. Now everyone should be a little bit weary of me. Frank, are you really an accountant? Do you understand tax? Why would you ever create a dividend instead of a capital gain? Dividends, generally speaking, are much higher tax rate than capital gains. I hope that there's some of you in the audience that is really connecting what we do as a living to this comment. Dividends are higher taxation than a capital gain. Well, they are if they're taxable dividend. What if they're capital dividends? I will take a capital dividend all day long versus a capital gain, because a capital dividend is tax-free. So just to summarize, we have a share redemption by an estate. The pro of doing it is that it's very easy to implement. It doesn't really cost much for an accountant to do a share redemption by the estate. The cons is that we're getting a dividend, tax on a dividend instead of capital gain. For now, I'm just keeping it outside of the realm of insurance. I got excited there when I mentioned capital dividend account. But for now, let me just say that the pro of doing a share redemption is that it's easy to implement. The con of doing it is that you get tax on a dividend instead of a capital gain. Pipeline strategy, pipeline planning. What does the pipeline planning do? This, I'm just going to summarize it to say, because this could get very difficult. I don't want to go through all the steps there. Let me just say that a pipeline plan has the individual keep the characteristics of a capital gain at death, and they eliminate the ability of having double taxation at death. That's all you need to know. That's more than most accountants know about a pipeline. What's the pro of doing that? The pro of doing that is that we retain capital gains rates. The con is it's costly to implement. Okay? Costly to implement a pipeline. So now from an insurance industry, here's the summary. From an insurance industry, if I could create capital dividends at death, then I like the share redemption method, because the share redemption method will now have my deemed dividend to be a capital dividend, which equals zero tax. So, another little water break. How does insurance fit into all of this? For simplicity, it's assumed that we're going to do some post-mortem planning, and we're going to have a little bit of pipeline strategy to preserve the capital gains tax at death. But I also want to include insurance, surprise, surprise, and I want to create a deemed dividend. So I want to do a section 164.6 estate redemption. And what I'm going to show, and this is exactly how I showed it to the client. Everything is how I showed it to the client. I shouldn't repeat that. To illustrate, I said to him, let's look at what a $2.7 million insurance death benefit at year 30 looks like. So I want to just show you 2.7 million, Mr. Client, Mr. John, Mrs. Sarah. What does $2.7 million at mortality at second death look like? Okay, here's where anybody that followed me until now, kudos to you. I'm going to get one step more technical, but again, I'm going to give you the takeaway if you don't follow what I'm doing. Number one, on the left-hand side, and this is basically me saying, I'm going to instruct the estate to redeem $2.7 million of shares post-mortem and do a pipeline for $7.3 million. I apologize. I have to say that chat box is right. This should be a 3-hour presentation. I'm notorious for trying to condense everything, but I'm going to press on. Thank you for that comment. Number one, the first thing I do is I redeem $2.7 million worth of shares of those 10 million that we received at death. Those preferred shares of $10 million, we're going to redeem $2.7 million worth. Well, what happens when we redeem $2.7 million worth of shares? We create a deemed dividend. That deemed dividend, surprise, surprise, we can elect for it to be a capital dividend because I have life insurance coming in. What's the tax rate on a capital dividend? 0. Fantastic. Share disposition. So after I do step 1, my accounting tells me that I do number 2. I understand that I have to do number 2. Well, number 2 is the process of me creating a capital loss. I'm not going to go through all the technical steps, but I create a capital loss of $2.7 million. Fantastic. Now that capital loss, let's go to step number 3. I use that capital loss to carry back to the terminal return. Surprise, surprise, that $10 million of capital gains is now down to $7.3 million of capital gains. Tax on the terminal return, if you take your calculators out and do 7.3 million times 27%, I can tell you it's going to be close to $2 million. So by us implementing a $2.7 million life insurance policy, A, we have cash now to pay the capital gains tax, but B, we've reduced the tax bill by $700,000. I hope everybody understands that. That's the takeaway. By us putting in $2.7 million of insurance in place to pay the capital gains tax, we've reduced the tax bill by $700,000. Okay, so what's this essentially worth in terms of life insurance policy? You're not buying a $2.7 million life insurance policy. You're buying a benefit of $2.7 million plus taxes saved of $700,000. I'm going to show you step by step. And again, because I have time, because I was going quick, I think I can do this. So if I showed you on this picture, look at red number 1. First thing that happens at death, when John and Sarah die, is that those free shares have a capital gains tax of $10 million. Tax bill is $2.7 million. Second thing is that we're going to have that payout from the insurer, $2.7 million of cash, $2.7 million of CDA. Third thing, over to the right, third red arrow, estate is going to redeem about $2.7 million of the 10 million of shares that they've received. Why 2.7? Well, because we get a capital dividend account of $2.7 million. Tax is 0. Number 4, new capital gain. Well, new capital gain is only $7.3 million because remember, I created a capital loss of $2.7 million. Fantastic. That new capital gain yields me a tax bill of $2 million. And number 5, the extra cash I have from buying just enough to pay the bill originally, I have $700,000 left over because we actually reduced our tax bill. I have no way of knowing if anybody understood this. I think many of you did, but I hope you all get the punchline here. We bought $2.7 million of life insurance proceeds to pay the tax bill at death. Surprise, surprise, that tax bill got reduced because of the nice, fantastic benefits that are attached to the life insurance policy, mainly the fact that we increase CDA at death. Okay, so let's start talking about the IFA now, because this is going to cost some money. So we're looking at this policy to be owned by Holdco. John's 55, Sarah's 57. We're doing a joint last to die because that's when we need the cash. Starting death benefit, it's a par policy. Starting death benefit is $2.5 million. And of course, my dividend option is to buy paid up insurance. Paid up insurance is going to give me higher cash value every year and higher death benefit. The annual premiums illustrated are $105,000, and I did an offset at year 10. That's just my nature. I like to do it for 10 years. I pass the file over to the banker. Banker likes that we have a finite period of funding. Everything works out really nicely. So I'm not going to waste too much time on this. I'm not going to waste too much time on this slide, but suffice it to say, I want to go to the year 30, life expectancy. Look at my column that says total death benefit under corporate life insurance. Total death benefit is $3,700,000. But Frank, I thought you were only accounting for $2.7 million to be available at death. Yes, but here's where I'm going to soften the price of this transaction. When John looks at this and he says, holy cow, Frank, 105, you know how much I can buy with 105,000 each year? I use my leverage model. I'm not very interested in giving you 105,000 a year or paying 105,000 a year to buy life insurance. Okay, no problem. So instead of $3.7 million, what if we could create an IFA? And here's where I'm going to transition the discussion exactly the way I did it with the client. How would an IFA look to help fund the $105,000 each year in Holdco? So we know that the policy has cash surrender value and we can access it at any time. Bankers, they're going to give you 100% cash surrender value on current -1. Each year, Holdco pays the premium and the bank will lend up the cash surrender value. And each year, I'm a bit anal about this, but I like to see Holdco paying the annual interest on the bank loan. In the early years, we're going to have, we're going to have cash surrender value that's less than the actual premium. So we're going to have to post alternate security, and I'll talk about that in a second. I like to show a picture format of what we're doing because a lot of times people might resonate with this. So number one, Holdco pays the annual premium. Number two, or number 1A, I should say, you can see my dotted line there. It shows that the policy is assigned to the bank after the policy is put in place. Number two shows that the loans equal the premiums paid by Holdco. Number three says Holdco pays annual interest on the loan balance. And of course, number four says Holdco receives a tax deduction for the interest and a portion of the premium payable. And number five is the reason that we do this. Number five says that the net cost of implementation, the net cost of owning this fantastic insurance policy, the net cost is annual interest less all the tax savings. So let's step back from that. We started by showing John and Sarah that they have to pay 105 times 10 years to do what they should do, that what they know is right. That's where we might lose the sale, where they say, you know what, fantastic, but I'm not doing this. I'm not spending 105 a year. Well, if we show an IFA, all of a sudden we're saying you're going to get the benefit, you're going to buy a death benefit, but your annual cost is not going to be 105 per year. And quickly, I just go through how we unwind this. We unwind it by showing, okay, well, if we're getting 3.7 million of proceeds, remember at life expectancy, I won't scroll up, but at life expectancy, this policy is expected to pay 3.7. We'll pay $1 million back in loan proceeds. How do I know the loan outstanding will be $1 million? Well, 10 years at 105 per year, I rounded down just to make it easy. 10 times 100,000 is $1 million of loan at death. The remainder goes into Holdco, $2.7 million. And we have that redemption, as I showed, for $2.7 million. Capital gains tax reduced by $700,000. You see, I worked backwards. I knew how much they needed in terms of after tax amount or tax liability amount, and then I structured the policy accordingly. Okay, so here's an IFA calculation. Here's my summary page that I put together when I'm working with clients. So on the left-hand side, that's the buildup of the actual policy. So I'm looking at, for those of you that are following the numbers, I'm looking at corporate life insurance, annual deposit, total cash value, and death benefit. So in year one, we've put in 105,000. Cash surrender value is 70. I'm rounding up to 70,000. Okay, fantastic. Ending loan balance. I'm assuming that they want it all back. So for them to get it all back, they're going to take back 105. So let me pause right there. If we put in 105 and we get back 105 in the form of a loan, up to that point, how much cash flow have we spent? Zero. We've put in 105. A few weeks after the policy is enforced, we get back our 105. So our cash account ends up net zero. Okay, well, here's the first place that I have to point out a potential issue. Banker is going to say, well, Frank, you know that for me to give back 105, if the cash surrender value is only 70, I need an extra $35,000 of collateral from somewhere. I can't be exposed. My collateral deficiency there, I'm sorry I ran this at 90%. It should be 100% collateral. That collateral deficiency should be only $35,000. But you can understand what I'm showing here. I'm saying, hey, Mr. or Mrs. Client, John and Sarah, you got to post some alternate security to get yourself back to 105. Most people that are looking at an IFA, they understand this. They understand that the banker will not be exposed to give 105 against only a value of 70,000. And by the way, when they do ask, can we leverage against death benefit? I hope everybody watching today knows, no, bankers will not leverage against the death benefit. Okay, annual cash outflow. How do I get to that annual cash outflow? I'm going to show you a slide on that. I go in detail, but high level, I've got a $105,000 balance outstanding at year one. If I pay interest on that, because that's what I push, I want people to pay interest on it. Well, if I pay interest, call it 4% interest, prime plus a half, prime plus 1, 4% is more than conservative for me to show. Well, at 4% on a $105,000 loan, I'm roughly paying $4,000 of interest. If I get a deduction on that interest, I get a deduction at 50%. The annual cash flow is roughly about half of what I paid in interest expense in year one. I do this all the way through for 10 years. At year 10, my outstanding loan amount is $1 million, $1,050,000. And from now on, I have an ongoing cash outflow requirement of basically paying interest expense until I die. At year 30, how does it look? Well, at year 30, I have a total death benefit of $3.7 million, $3,705,000. Ending loan balance is $1,050,000. And the net amount going to the estate is going to be roughly about the difference, $2,600,000, $2,700,000. I've rounded up. My tax analysis screen, this just shows how much of a deduction I get every year. And basically it's showing the collateral interest deduction and it's showing the loan interest deduction. Please, let's not get caught up with this. I don't want us to really get caught up on this for now. Net cash flow, this is a more important number to look at. So you look at year one, I've paid $105,000 in. I've taken a loan of $105,000 back, so I'm net zero. I pay loan interest, 4% of $105,000 is $4,200. My tax savings came from the prior slide. So there's my cost in year one. Let me go all the way to year 10 and look at that line that says net cash flow. Net cash flow in the first 10 years of doing this is less than $100,000, right? When I add all my net cash flows, it's probably going to be somewhere around 100 or very close to under 100. As opposed to if we didn't do an IFA, this would have cost us $105,000 each year for 10 years. Okay, now here's where I'm gonna, if you haven't been confused, I'm gonna try to confuse you a little bit more. Sorry, I took a glass of water there, a little bit of a break. I'm sure when I did my previous slide about 3 or 4 slides ago, I'm going to show you the slide. There's probably some of you saying, hey, Frank, you know what? You made a mistake. Why, when you did this slide, why didn't you assume that the CDA was going to be a full $3.7 million? I thought that all you guys talk about, and even in number 4, you put this big bold lettering saying CDA credit is unaffected by loan repayment. So I didn't make an error. Trust me, I didn't make an error. I didn't want to confuse the client. If I hadn't already confused them, this would have confused them. So I made sure that they understood all of this. But in the back of my mind, I said, hey, we could do a redemption for more than $2.7 million. Because remember the rules. Just because there's a loan outstanding, that does not affect our CDA credit. I think many of you will understand that point, and many of you probably looked at me and said, Frank, you're an idiot because you missed the extra CDA. I didn't miss the extra CDA. I just didn't want him to be lost. I didn't want John and Sarah to be lost in the whole discussion. So now when I realize that they understand everything, I say, okay, John and Sarah, you understand everything. Now I'm going to give you another curveball. This policy, let's look at the bottom under the picture that says insurance policy. That picture shows death benefit of $3,705,000. Everybody understood how I got that? You saw that in the spreadsheet. If I look at the CDA calculation, well, it's not a full payout of CDA, or it's not a full credit of CDA at year 30. The amount of CDA at year 30 created is roughly $3,350,000. Okay, so let's look at number 2, and let's look at that net cash column there, that net cash little box. The net cash box says that I have 3,700,000, back out the 1,050,000. I've got roughly 2.7. I keep talking about this $2.7 million of cash. But the CDA credit is $3,350,000. $3,350,000. Now, thank you very much. I'm going to say whoever put that comment, because my eyes keep going to the screen. Someone said in 20 years, they've never seen something easier. I think that this is a little bit difficult because I'm going at a fast pace, but I appreciate it. I try to keep things simple. That's my style, because we're not selling to a bunch of accountants and lawyers or insurance advisors. We're selling to clients. And if clients don't understand this stuff, they're not buying it. So again, CDA credit is for $3,350,000. So I'm going to go back to that redemption. Remember what I said. Remember earlier, I said this. I said that when we do a share redemption, we create a deemed dividend, right? And I also said, if I create a deemed dividend, that's in lieu of a capital gain. So when I go back to this slide, I say to myself, sorry, not this slide, this slide. I say to myself, why would I only redeem shares of $2.7 million? I showed that for simplicity to the client. But if the client is engaged and they understand what I'm doing, I'm going to go one step further. And I'm going to say the share redemption should not be for only $2.7 million. The share redemption should be for the full capital dividend account. The full capital dividend account in this transaction is $3,350,000. So if I'm doing a share redemption of $3,350,000, that reduces my capital gains at death. When I do this, I pay it out, the deemed dividend or the capital dividend on the redemption, I owe $3,350,000. There's nothing saying that I can't take $2,655,000 in the form of cash via the life insurance, and the extra $695,000 is an amount payable. It's a shareholder loan payable, tax-free. When they eventually get the cash, they'll funnel that out tax-free. What happens to the capital gains tax by me redeeming for the full amount of CDA? Capital gains tax now is essentially reduced by $904,000. The reduction is the $3,350,000 that I've redeemed times the capital gains tax savings of 27%. How do I put this in plain English? I had a $10 million capital gain to start. I got a $3,350,000 CDA credit to Holdco. I got $2.7 million of cash to Holdco. The $3,350,000 of CDA credit allows the estate to redeem $3,350,000 of shares. That redemption is declared to be a capital dividend. So on $3,350,000 of transaction, I have zero taxation. All I pay tax on is the $6,650,000 of capital gains tax. How do you like that solution, Mr. and Mrs. Client? John and Sarah, how do you like the fact that we've created so much wealth for you? You didn't buy a $2.7 million solution. You bought a $3.6 million solution, because that $2.7 million of net cash into your family's pocket has reduced the tax bill by $904,000. And in case you haven't understood, Mr. and Mrs. Client, how good this is, I'm going to reconcile all the benefits. Now, someone said to me, Frank, you know, you should do time value of money. And I said, I'm not doing that. I'm doing this in just a simple format. I'm not going to start to discount back cash flows. I'm just doing this simply as a summary of what's happened. Total premium paid. Total premium paid is $1,050,000. Basically, that's 10 years times $105,000 per year. That's a negative, because that's a cash outflow to the business. How much did we borrow back? We borrowed back $105,000 times 10 years. So from a premium perspective, our cash flow is neutral. Our premium dollars were funded by our cash, and they came back from the bank loans. Okay, fantastic. Total interest paid annually. Well, what this is me looking at my year 30, and you can see that my spreadsheet on the right-hand side, life expectancy year 30 on the right-hand side all the way over. Sorry, I have my box jump. all the way over shows a running total of all the annual net cash outflows, all the way up to any given year that I want to pick for death. So at year 30, the annual or the cumulative cash flows over 30 years of me implementing this is $436,000. That's basically all the interest payments I've made minus the taxation, the tax savings on the interest payments and the NCPI. Okay, fantastic. How much death benefit did we receive? Death benefit that we received is roughly 3.7 million minus the $1 million of loan outstanding, right? Remember, we have an outstanding loan. So we have $2.6 million of cash created by the carrier. Fantastic. How much taxes did we save from all of this transaction? Well, it wasn't just the 700,000. Remember, I showed the client that it's not 700,000, it's 904,000 because we're saving based on the full CDA credit and the capital gains that we're not paying at death. All I'm doing at the bottom is saying, as of today, this is creating wealth to your family of roughly $3 million. This is creating wealth to your family of $3 million. Why? Because you've spent $1.05 million in premium. You got that all back. $1.05 million of premium is all back. You spent $436,000 over 30 years. Now think about the hit. Now think about John and Sarah's decision making at this point. They're not looking at 105 every year for 10 years. They're looking at a total of 400,000 spread out over 30 years. That's a much more palatable expense or cash outflow. And by the way, John and Sarah, that $436,000 that you spread out over 30 years is going to bring your family back $2,655,000 of actual cash plus $904,000 of tax savings. When I add up all these numbers, the total sum is that we're creating wealth to the family of $3,123,000. That's the numerical component of this. Now there's the I feel good component. I feel good because, as John and Sarah, if this plan isn't in place, what happens? If this plan isn't in place, then the recipients of the shares have to start to figure out what assets have to be distributed in order to pay this bill. So keep that in mind. If this isn't in place, we've left our family a very good portfolio. Like, let's not kid ourselves. We left them a fantastic portfolio. But John and Sarah, as they age in life, they probably are going to get very attached to the properties, and they're probably going to get very attached to what they've built up for their family. So now we're saying to them, there's nothing that you have to sell. The solution is here, and we've provided you a very easy way to implement it. I shouldn't say easy. By all means, people, an IFA, what we did here is not easy. I don't want you to think that this is the type of deal. I don't think anybody thinks this, but this is not the type of thing where we meet the client once, we present to them what Frank put together. Second time, we take an app. No, these things could take anywhere from 4 to 6 months. This one started roughly in about February or March of this year, and recently just closed in August or September. Late August, early September is when this actually closed. There's a lot of moving parts. So these cases are difficult. And we're not looking at the guy that's going to do a $10,000 premium. I want to keep it realistic. Carriers, most of the big banks won't touch this until it's $250,000 of annual premium. And then when we get to smaller banks, Manu Bank, I believe their minimum to get into an IFA is $30,000. Stacy, I see you. I want to make one last point. If we transition this to a business that's an operating business, I want to just make this point. There's a lot of operating businesses that are worth 5 million, 10 million, whatever it might be, given the estate freeze value. Well, an operating business has a much tougher time to pay that tax bill at death, because that operating business cannot sell assets to create that $2.7 million of liquidity. But guess what? Their valuations, their accountants, their business valuators are saying the business is worth X amount of million. This makes a lot more sense. It makes sense in both dynamics, but it's a lot more important for that business owner that has, call it whatever business, a construction business, a a computer business, whatever it might be, that business that's worth a lot of money but doesn't have cash. They're asset rich, cash poor. Think about this as being their way of making sure that the viability of the business continues. Stacy, now I could pass it over to you.